Okay, so just quickly, can you see my screen and can you hear me? Just thumbs up.
Trippy Tropper.
Okay, perfect. Okay, everyone. So welcome to the Test 2 Masterclass covering learning units 3 and 4. So my name is Claudia De Rocha. I've taken the financial management masterclasses this year. So this will be the fourth one that I've taken now. Second one for the FINM7322, so Financial Management 3B. There's just someone I think who's sharing their slides on their side. So if you can stop doing that because it's basically taken over my screen. Yeah, thank you. Just reconfirm that everyone can see my slides again. Cool, perfect. All right, so the overview of Learning Unit 3 and 4. So Learning Unit 3 covers scrip dividends, share splits, and share buybacks. So it's not a very big learning unit. Your larger learning unit is Learning Unit 4, which covers cash conversion cycle, inventory management techniques, accounts receivable management, and cash management. So 4 topics versus 3, which obviously means in terms of weighting in your test that it will be more weighted towards Learning Unit 4, but there will be both Learning Unit 3 and 4 in your test. In terms of how the session has been structured, it's the same as what was done in previous master classes. So we'll go through the formulas for each learning unit. So I do like to create formulas to answer the questions so we can answer them with some kind of basis. And then we'll look at them in more detail, and then we'll do 2 past papers today, one for Learning Unit 3 and one for Learning Unit 4. Okay, so to start off, before I go into the formulas, for Learning Unit 3, you need to understand the difference between scrip dividends, share splits, and share buybacks. Scrip dividends is when dividends are paid through the issue of shares. It's quite important that you know how to identify this in a question, and today we will look at a question that covers that. Then share splits. This is when we are, or a company is basically creating more shares or less shares. It can be a share split or a reverse share split, which doesn't really have an effect on the balance sheet, but does affect the number of shares. So we also need to just understand that in case it gets thrown into a question. And then share buybacks is when the company purchases back their shares that they've issued. So we need to understand when that happens and what are the calculations around it. Learning Unit 4, cash conversion cycle is, the time it takes for us to create cash. Inventory management techniques, I'll unpack those different ones when we get to the formula section. And then accounts receivable management and cash management, there are specific formulas and calculations we need to look at to understand how we manage those 2 parts of working capital better. Okay, so Learning Unit 3, formulas that you need to know are in essence a recap or revision of Financial Management 2A. You would have done these formulas then. Potentially the only difference is how they're written, because I've just abbreviated them so it's just easier to remember. So we've got earnings per share, which is our earnings over a number of shares issued. You've got your price to earnings ratio, which is your share price over your earnings per share. You have your dividend per share, which is your total annual dividend over your number of shares issued. Okay, we have our dividend payout ratio, which is our dividend per share over our earnings per share. So this tells us how much dividend as a percentage or as a ratio will be paid out. We have retention rate. So retention rate is how much of earnings is retained. And when we say 100 minus DPO, we're talking about that the dividend payout ratio is in a absolute percentage form. So what I mean by that is if our dividend payout ratio is 50%, it would be 100 minus 50, which means that your retention rate is 50%. Okay, and the last one that we have for Learning Unit 3 is market capitalization. Market capitalization being the number of shares issued times your share price. So also a 2A formula that we would have gone through or you would have gone through then that we need to know now. Some of these also would have been covered in 3A when we did the masterclass. Some of them would have been covered or in the content that would have been covered. Okay, let's go on to Learning Unit 4, and then I will unpack each of these in more detail on the mural on the whiteboard. Oh, the two that I forgot for Learning Unit 3 is your buyback share price. Apologies for that. So your buyback share price is your share price plus your dividend per share. In most cases, your buyback share price, they do increase the share price with the dividend per share, but the question will obviously tell you as well. And then the other one is the number of shares in issue after buyback. So this is a typical buyback question where you need to know how many shares are in issue after the buyback has occurred. And the formula is your market value of your shares divided by your buyback share price. All right, so let's move on to now Learning Unit 4. So we have our cash conversion cycle with two formulas. So your cash conversion cycle is either your operating cycle minus your accounts payable days, or if you want to break it up, it's your inventory days plus your accounts receivable days minus your accounts payable days. Your operating cycle is your inventory days plus your accounts receivable days. Then comes your days and how to calculate them. This also was based on Financial Management 2A concepts that were covered then, maybe just slightly or written slightly differently in your textbook for 3B, but same principle. So your inventory days is your average inventory divided by your cost of sales times 365. Your accounts receivable days is your average accounts receivable divided by your credit sales times 365. Your accounts payable days is your average accounts payable divided by your credit purchases times 365. And then we move into the investment piece. So questions will either ask you to calculate the number of days for either operating cycle, cash conversion cycle, or a aspect of either one of those. The other section is to calculate the investment required in your cash conversion cycle. So there are three formulas, of which one is in essence, or two are in essence related to each other. So here, this first one here that I'm highlighting, that is your average investment in the cash conversion cycle. So it's either your average investment in your operating cycle minus your average investment in your accounts payable. Or you can break down your average investment in your operating cycle into your average inventory or average investment in inventories plus your average investment accounts receivable, and then deduct the average investment in your accounts payable. The other formula that's also quite popular is to take your working capital, times it by your cash conversion cycle, and divide it by 365. That's also popular if they've given you the working capital values, or at least a way in which to calculate your working capital, and a reminder that your working capital is in essence your current assets or your net current assets. So it would be your current assets minus your current liabilities. Okay, just a breakdown of the average investment in your operating cycle, which is your average investment in inventories plus your average investments in account receivable. And then each of the investments in your working capital, so inventories, account receivable, and accounts payable, have formulas. For your average investment in inventories, it is inventory days times your cost of sales divided by 365. Obviously, in a question, if they tell you that the number of days in a year is 360, that's what you use. But in essence, most cases it's 365. Your average investment accounts receivables is your accounts receivable days times your credit sales divided by 365. Then your average investment in your accounts payables is your accounts payable days times your credit purchases divided by 365. Then into a different section relating, I wouldn't say relating to cash conversion cycle, but part of managing your accounts receivables and understanding how to manage your working capital is the funding requirements. Okay.
Huh?
I'm gonna check that everyone's on mute. Just give me a second.
Uphi Iza? Ndiseklasini ngoku.
Okay, apologies for that. All right, so when we are dealing with funding our working capital, we have basically different types of funding requirements that can exist. And we have either the permanent funding requirement or we have a seasonal funding requirement. We also have the strategies, which I'll also unpack, all having to do with our cash conversion cycle. So your first one's your permanent funding requirement, which is equal to your minimum funding requirements. In essence, when you get a list of different funding for different months, you will choose the lowest. Then we have seasonal funding requirement. So this is when our cash basically fluctuates, not consistent. So to determine what we need, we will take our highest funding requirement less your permanent funding requirement, which is the minimum. Okay, we also have two strategies that we use when we are dealing with cash. One being the conservative funding strategy, and then the other one being the aggressive funding strategy. You need to know how to calculate the cost of applying each of these strategies and then deciding which one is best. Okay, so that would be a typical question. So to calculate the cost of your conservative funding strategy, you would take your highest funding requirement times by the cost of the long-term debt. Your cost of the long-term debt is generally your interest on that. Again, or not again, but just a note that with the cost of long-term debt, you can be asked to calculate the cost using principles from Learning Unit 1. So just be aware of that. Right, then we have the cost of aggressive funding strategy. So your cost of your aggressive funding strategy is the cost of your permanent funding plus the cost of your seasonal funding. And how do we calculate those? So your cost of permanent funding is your permanent funding requirement times the cost of the long-term debt plus your seasonal average funding. So it's not the same as the seasonal funding requirements, is your seasonal average funding times your cost of your short-term debt. So it's quite important when you get questions asking you to determine which strategy should be applied, that you understand which is the long-term debt, which is the short-term debt, and that you also understand that your seasonal average funding is in essence taking the total value and creating an average for the months that you're getting funding for. Okay, so now moving on from cash, basically a cash conversion cycle, we're moving into inventory management. So there are, in essence, a few sets of formulas that we must know. Economic order quantity was something covered in 2A before, so it is from that. This formula is similar, except they've just changed some symbols to relate it to what's here now. And it is a square root. So I know this looks like a little tick, but it's a square root of this entire formula. So it's the square root of 2 times your cost per order times your annual demand or annual sales in units divided by your carrying cost per unit plus the cost price per unit times I. So this P times I here only is applicable if the inventory has been funded by debt. So you need to look out in the question if they mention that. If there is funding with debt, then your P times I is applicable. If there's no mention of inventory being funded by debt, you will then drop this part of the formula and just have it divided by CC, which is the carrying cost. Okay, the other formula that's quite important in terms of inventory management is your total cost of inventories. And just be warned that when we say the total cost of inventories, it does not include the purchase price of inventory. So when you're dealing with an inventory question where they're looking at changes in credit terms, you need to take into account your inventory that you've purchased plus these items, which is your order cost and your carrying cost. So please just make note of that. So in terms of this formula, the total cost of inventory, it is your order cost plus your carrying cost. Your order cost is calculating by saying C times S over Q, C being a cost per order, S being your annual demand divided by Q, plus the carrying cost times Q divided by 2. So carrying cost per order divided by your order quantity. Okay. Then we have reorder point. So just to clarify, when we talk about economic order quantity, we are saying what is the minimum amount of inventories we should be ordering every time we place an order. And it's taking into account what you need to fulfill your sales, in essence. Reorder point now is saying to you, when inventory reaches this level, so let's say 600 units, I will need to place an order of the EOQ. Okay, it's quite important that we understand that. This was covered in 2A, but it's important that we know this now again and that we're able to actually state that in a question. So if a question comes up asking how many units should you order and when should the order be placed, you know that how many units should be ordered is the EOQ and when should the order be placed. We know it's got to do with the reorder point where we identified what inventory level we order. Then with the reorder point, we have two formulas, one being when we don't have safety stock and the others when we have safety stock. So safety stock, to remind you, is when we keep stock in the warehouse for, I suppose, a bad day, rainy day, or in case situations happen or there's an accident or stock gets stolen. So that is your safety stock. Okay. So the first one, RP is equal to ALT times AU. That is without safety stock. And it is your average lead time times your average usage. Lead time being how long it takes for your stock to reach you from when the order is placed. Average usage being how much you use. What's important is with your lead time and average usage that it is the same denominator. So what I mean by that, if your lead time is weeks, your average usage must be weeks. If your lead time is a day, average usage must be days. Okay, it's very important. Then reorder point, the second one is with safety stock. So that W is for with safety stock. Okay, so with safety stock, it is the same formula as we had before, which is your average lead time times your average usage plus your safety stock. So you're going to add your safety stock on top, and there are specific ways to calculate your safety stock. So how do you calculate your safety stock? There are two ways. One is the first formula is from Financial Management 2A, where you learned how to calculate your safety stock, and it is the maximum expected usage minus your average usage. So if in a question they say to you that the maximum amount of stock that is expected to be used is X, and you know your average usage, you will then minus the one from the other. The formula that's most common in 3B, or the, I suppose, calculation method that is most commonly used in 3B, is the second one, where we take the days the safety stock is held times your carrying cost. Okay, so this is quite important, especially if they're asking you to calculate the impact of a change in credit terms on your suppliers. You look at your inventory. Okay, it's important. It's also a Learning Unit 5 concept, but it's also in Learning Unit 4 when you change the credit terms of your suppliers. And then this is generally the formula that is used to take into account safety stock. Right. Okay, now that we've looked at those key items under inventory management, we now need to look at accounts receivable management. Okay. So with accounts receivable management, we obviously have our average receivable or accounts receivable days. That's one way to manage. But the other way that we can look at accounts receivables is using, I suppose, two models that exist. Okay, so with your accounts receivable, so it's not the two models, it's more comparing two types of policies. So I will do a question on that. There isn't per se a formula for that. There's more a method to follow, right? So with accounts receivable, we look at the accounts receivable days, or we will look at change in credit terms. For now, these formulas now are for our cash management. Okay, the first one is part of one of the models that exist. There are two models that you need to know. The one being the Baumol model, and the other one being the Miller-Orr model. Okay, this is the Baumol model. And in essence, it's a way of determining what would your optimal cash balance be. So what does your cash balance have to be for your business to function optimally? And this is the formula. Again, this little tick is actually a square root. So it's 2 times your administrative costs times your annual cash requirement divided by the interest cost. So this is important to know this. The other formula under cash management is your return point, which is part of the Miller-Orr model. And your return point is basically the point at which your cash is maintained at an optimal level. So with the Miller-Orr model, we talk about if we have excess cash, we will invest. If we have deficit cash, we will then sell off our investments so that we are always at our return point. Excuse me. So the formula for return point is your lower limit plus a third of the spread. The lower limit being the lower end of where your cash will land. So if you look in your text box, and I'm not going to cover this in detail today because we've got to make sure we know everything else. But there is a graph on page 135 of your textbook that actually shows you the lower point, the return point, and the upper limit. Okay, the lower limit, the upper limit, and the return point. It's important that you understand that the lower limit is the lowest point at which your cash gets to. The upper limit is the highest point at which your cash gets to, and your return point is where your cash is stabilized. Then, in terms of the spread, so this is part of the previous formula. So if you look at the previous formula, it's saying a third of the spread. The spread is 3 times 3/4 of your transaction cost times your cash flow variance divided by your interest rate to the power of a third. Okay, so it's important that we know this, because when we are calculating our return point, we are going to be calculating the spread. Okay. Any questions at this point? I'm going to just unpack these formulas a little bit more, and then we'll go into some questions or some past paper questions.
And how can we practice these? Because there's not really much in the book.
Yeah, that is true. There isn't much in the book. And there aren't any other questions in the back either. And there aren't a lot of, or there aren't any past paper questions that I've seen that test this particular return point, etc. So my answer to that is just to make sure that you understand the example, and then I think there is only like one question that really covers it. Yeah, and that would be it. Unfortunately, those are the only kinds of questions I have. Yeah, there's nothing else. I'll try and see if I can. I have looked, but I'll try to see again if I can get something somewhere. But there isn't really any other questions on this. Okay, so the question in the chat is, must we memorize these formulas? Yes. So a lot of these formulas don't actually exist in your textbook. These are ones that I've written out. They're here to help you so that you can answer the questions, because if you look at the examples and also the answers in your textbook at the back, it literally just goes into calculations and doesn't really give you a base as to how you should attack the question. So a lot of these I've just created based on the information in the textbook. So a lot of these will not be on your formula sheet. So if you find it easier to understand finance with formulas, then yes, you would need to know them so that you can tackle the question. I hope that answers you, Lisa. I'm just going to respond to you on the chat. Okay, any other questions before we just dive into the formulas a little bit deeper? Okay. Doesn't look like there's any. So I'm going to shift now to the whiteboard so that we can just go through these formulas in a bit more detail so you understand. And then we're going to tackle past paper questions. There's only two, one for Learning Unit 3 and one for Learning Unit 4. Yes, sorry, please confirm if you can see the whiteboard with thumbs up. Perfect. That was on mute for a little bit there. Sorry about that. All right, so Keegan, I see your, okay, I think it's just you telling me that.
Sorry, Gloria, that was a mistake.
Okay, cool, no stress.
Typical Howie.
Okay. Right, so let's go through the formulas. So I cannot iterate enough how important it is to know these for learning unit 3. Okay. Unfortunately, learning unit 3 is not the nicest learning unit. The formulas are pretty basic, as in it's earnings per share, price, earnings, it's things you've seen before, but the way that it's asked and what you need to do can always be tricky. So it's very important that you understand what's available, what information is available, what's being asked, and that you can apply the formulas in different ways. It's very, very important. And I will show you today with a question how it can be quite, tricky to see what is being asked, right? And what formula needs to be applied. All right, so earnings per share, we all know that. Earnings, another word for earnings is net profit. So, you got to be careful that that doesn't come up, that they're saying to you, here's net profit, and then you must know that it's earnings. So it's quite important that you understand that and the different ways of getting earnings. Your number of shares issued has to be ordinary shares. So please don't get tricked into finding that they are preference shares and that you try to include them. It's only for ordinary shares. So please make sure that you make a note of that. It's only ordinary shares. And the other thing is must be ordinary shares issued. Okay. So don't get tricked by the fact that they are authorized shares, that there are shares that were bought back, whatever it is. It's your ordinary shares issued. It has to be what's in the market. It's very, very important that that's the case. Okay, so these are all the things that could happen. Right, then your price earnings ratio is your share price divided by your earnings per share. And the share price is always the current share price that will either be given to you, or you need to calculate it. So just be wary of what they're asking you to do. Again, they can ask you to calculate it backwards if they want, as in applying a formula in a different way. So, let me see what formula we have here. Yeah, so like here, market capitalization, which we'll go through just now, this one here has share price in it. So they could ask you, you can calculate share price by using this formula. So you need to be wary of where there's similar elements. So as you can see here, with your earnings per share and your price earnings ratio, you can see that EPS exists here, EPS exists here. Therefore, we know that there's a way to calculate EPS in a different manner. It's very important that you understand that, and that you can manipulate the formula, which I will show you today in any case, because our question today does look at doing that. Right, then dividend per share, total annual dividend divided by your ordinary shares issued. Okay, so it's the same as this at the top here. Okay, actually, I'm not going to do that. I'm just going to highlight it with the same color. Okay, so this is the same as this one here. Okay, same amount. Your total annual dividend, so please be very careful. It's the full dividend or all dividend declared in the year. So if there is an interim dividend and a final dividend, you need to add both dividends together to get your total annual dividend. So please don't get confused by that or tricked by that. It's your total dividend for the year. Okay. And yeah, and again, to note that you have elements reoccurring in calculation. So here's your dividends per share, which is also in here. Okay, we also have our earnings per share in the other formula. So again, depending on what they've given you in the question, you can interchangeably use these formulas to solve different elements. So it's very important that you are able to see that. Okay, so DPS, we can get it from a dividend per share, either from our dividend payout ratio formula or from the DPS formula itself. EPS now, we can get it from DPO, we can get it from EPS, we can get it from price earnings ratio. And that is what makes Learning Unit 3 questions difficult. It's not the formulas or the content, because the content and the principles behind are quite straightforward. It's how to tackle a question, right? Then we have the retention rates, quite important because this is what tricks individuals. Okay, so again, we have the DPO, dividend payout ratio, coming again. So formulas crossing over, right? Then market capitalization, this will be quite important for our question today, because they do ask us to work out the market value of shares. So market capitalization is another word for saying market value of your shares. Literally, that's what it is. And again, we have similar elements. So we've got our selling price again. If I just zoom out, we've got our selling price again. Not selling price, our share price, sorry. Our share price. We have our NSI, which is our ordinary shares issued again. Okay, so again, if you can see, all of these formulas somehow have an element within each other. So there are, like I said, ways to manipulate different formulas to get the information you need. Okay, and we're going to look at that in our question today. Right, then your buyback, it's quite important. Your buyback share price, again, we have the share price. Okay, again, appearing again in another formula. And then your DPS, which we have here, appearing here at the bottom. Okay, so all of these formulas interlink somehow. And again, like I said, that's what makes it tricky. I'm trying to get it to come here. Okay, not a very neat line, but you know it all interlinks. All right, and then your number of shares in issue after buyback. So in your textbook, they tend to calculate the number of shares that have been bought back and then deduct that from your shares that you have already in place. So this form is a shortcut. It takes you straight to the answer. It takes you to the issued shares after buyback. So it does skip a step, and I find it's just easier to do it that way. So you've got your buyback share price, which again, these formulas interlink, right? And then you have your market value of shares. Okay, and when I say market value of shares, in essence, it's basically your market cap, actually, because it's the number of shares times your share price, literally. So those also interlink. Okay, so which then this one also interlinks here. So like I said, lots of similarities. Okay, and that's what makes this learning unit difficult. In my view, not the nicest learning unit. I'm not a fan of this one, me personally. All right, any questions on those formulas before I unpack the learning unit 4 ones? All right, no questions. Okay, let's go to the learning unit 4 formulas then. Okay, so generally speaking, the learning unit 4 formulas are quite, straightforward. Your cash conversion cycle, etc. are not terrible. It's not a terrible section. I think it's a section that most people can do well, which is quite nice. So, just to note that there are pieces of other formulas within each other. Okay, so your operating cycle is obviously your inventory days plus your accounts receivable days. So just noting the similarities and where formulas sort of cross-pollinate, right? So again here, APD or accounts payable days. Okay. And it's all concepts because it's been done before. These are not new. As in your accounts payable days, etc. That's not a new concept. Putting together into a cash conversion cycle, yes, that's new. But everything else, you should know. All right. Here we have our accounts receivable days, okay, which all interlink because I've tried to show you how these all come together. So this one comes here, and then this one comes here. Okay. Okay, so very important that you do know how to calculate the days itself. So again, all part of something that you've done before. And yes, maybe written slightly different in your textbook compared to what you would have learned in 2A, but in essence, it's the same principle. Okay. Right, so with your inventory days, it's your average inventory divided by your cost of sales. So what's very important, number one, is that your average inventory has to be the average. So when I say average, I mean it's your opening and closing inventory divided by 2. Okay, this is a concept you would have learned in 2A and has been brought forward now into 3B. Okay, so if you get a balance sheet with inventory on there, please make sure that you're taking your opening and closing balance. Or divide by 2. Okay, it's the average. Cost of sales, we know what cost of sales is. Obviously, how can they make it trickier? They can give us a markup percentage. They can give us gross profit percentage, and we have to work backwards. Yeah, they can give us contribution, and then we know that only has a variable cost in, so then we have to add the fixed cost, whatever it is. These are all things that you know already. So they could obviously make the calculation of your cost of sales a bit more trickier than just plain cost of sales. Okay, and this is how they can make the section trickier. Okay, with your accounts receivable days, it's again your average accounts receivable, which again is your opening and closing inventory, opening and closing accounts receivable. So again, you're doing the average. Okay, so it's very important that we follow the same principle. And then what's critical is we have our credit sales. So very important that it is on credit. Okay, and again, they may give you information to calculate your credit sales. So you need to understand whatever it is that they tell you, it's 50% of sales or it's 50% of cost of sales, whatever it is that you can calculate it. Okay, so please make sure that you read the questions, very important. Right, with accounts payable days, which also goes into our formula here. So accounts payable is here. Yeah, so accounts payable days goes all the way to the bottom. Okay. And again, we have our average accounts payable. Again, divide by 2. Again, opening and closing balances. So these are the same principles over and over again being used, just with a different working capital element. Okay, or net working capital element. Okay, opening, closing balance times 2. And then we have our credit purchases. Okay, again, read the question on how to calculate this, or if it's given to you, whatever it is, you need to be able to calculate this. And again, it's not standard. It all depends on the question, what they're trying to test, etc., etc. So please make sure you follow the question. Okay. Then we move on to the investment pieces. So this is when we're going to put rand amounts. So all of this above that we did now, this is all days. The answer is days. Cash conversion cycles, days. Operating cycles, days. Inventory, days. Accounts receivable, days. Accounts payable, days. Everything's in days. Okay. When we move to the investment pieces, everything is in rands. So it's rands now. We want to know what it costs us. Okay, and then again, the formulas cross-pollinate. So we have your average investment and operating cycle, which goes into the over here, or is made up of that formula. Okay. We then have the average investment in inventories, which goes into our average investments and operating cycle, which also goes into the average investment inventory, where there's a separate calculation. Okay, so again, same principle as with the days. We're following the same thing where we have elements within each other. And so again, they can ask it to you in different ways, asking you to calculate it with different elements. So it's important that you can see that. Okay, including your investment in accounts receivable. Okay, so investments in account receivable is there. And then we have the specific calculation for our investment in accounts receivable. Right. Okay, then if we then zoom into the average investment in inventories, average investments in accounts receivable, average investment in accounts payable, again, using what we know, so the inventory days times our cost of sales, our average receivable days times our credit sales, average payable days times our credit purchases. Okay, so in essence, it's very similar to calculating your days of each one, but they're just bringing in rand amounts and just changing it over, or flipping the formula a little bit. All right. Yes. The other thing I did forget is when we are dealing with your average investment in cash conversion cycle, you will see there are 3 formulas. 1, 2, 3. Okay. 1 and 2 here are basically the same. All we've done is we've unpacked the average investment in operating cycle. Here, this formula number 3 is where we're not given the details for each element of our working capital. We're just given the total. Okay, so this is where we have a total investment amount, and then we have to calculate. So we have our working capital here, okay, which again, like I said before, if you get current assets and current liabilities, you're going to add up all your current assets, you're going to less your current liabilities to get this amount. The other alternative is they give it to you. Okay, they give you a total investment amount. So just be careful when you're tackling this question like this, what happens. And you have your cash conversion cycle, which we had done over here. So this answer comes from above. And generally speaking, when you have a question where they want you to do the investment piece, they'll either get you to calculate your cash conversion cycle first, or they expect you to do it as part of the question and then obviously answer it. So just make sure you see that. Okay, so you can see that they're all of these formulas interlink in essence. Okay, then your funding requirements when you're dealing with your cash conversion cycle, please, it's very important that you know what these are, that you know how to calculate them. They may not be for a lot of marks, but it's important that you know how to do it. Permanent funding requirement is your minimum funding requirement. Okay, so this is your minimum. So when we say minimum funding requirement, we are talking about the lowest amount. So if we are getting funding each month for 12 months, we'll take the lowest out of all of those. It's very important that you know this. Okay. Same with your seasonal funding requirement. Again, all these formulas, they're all interlink with one another. So we can see here we have our permanent funding requirement coming from this piece of the formula. And then you have your highest. So that would be the highest value that you have there. Okay. Then we have, like I said, the two funding strategies. Either we can be conservative or we can be aggressive. Okay. Conservative means we obviously want to take out the lowest cost. So that's why we're using long-term debt. Whereas aggressive, we're happy to take into account that our cash will fluctuate and therefore we can take a knock or two, if the cash is exceeding like our upper limit, lower limit, etc. Right. So it's very important again that you can see I suppose, elements within each other. So like here we have our highest funding requirement. Okay. And then we have our cost of long-term debt. It's very important that long-term debt is being used. You don't use other debt. I'm trying to use darker colors because these lighter ones are quite hard to see. Yeah. Then we have our cost of aggressive funding, which is our cost of permanent funding plus our cost of seasonal funding. And then in essence, I've broken down the formula here. So this is for that formula. Okay. And then this one is for this formula. Okay. Right. And what's very important again, we can see similarities. So again, we have our permanent funding requirement. So the permanent funding requirement that we did up here, okay, pulls into here. And then we got our cost of long-term debt, which is the same as what we have here. And then here it's a bit different. You have your seasonal annual fund, which is an average. So in essence, the way you would calculate that, and I'll just write it here for you. So it is get the right value quickly. Okay, so this one would be your sum of your what would I call it? Your difference between your permanent funding, or your basically your sum of your seasonal funding, okay, which would be the difference between your permanent funding so your sum of your seasonal funding, and then we divide that by the number of months that we have funding for. Okay, so I'll recap that again. So what we are saying here is that when you deal with a question for this formula, that you need to take your total funding for each month less your permanent funding, so the minimum amount. You'll get differences, add those all together, and then divide by the number of months. I see there's a hand. Jordan, you have your hand up?
Hi, ma'am.
Oh,
I just wanted to ask, do we have to use these exact formulae in the test, or like as long as we kind of make sense?
yeah,
Is
as long as
that
you
fine?
yeah, that's fine. As long as you kind of make sense, it's all good.
Okay, cool. Thank you.
Yes, no stress. All right. Cool. And then you've got your cost of short-term debt. Remember, you can even write these words out. I've just abbreviated to make it easier for myself. But I mean, if you want to write that seasonal funding is calculated by the average or whatever it is, as long as it's understood, all good. And then we have our cost of short-term funding. All right. Then with the EOQ, so inventory management, like I said, we've got the EOQ, which is our order cost. Just going to run through these a bit quicker. Okay, your order cost. Or your cost per order. You be very specific because there are there are some similarities between formulas, but I'll just go through that quickly. Okay, so we must be careful that this is C is the cost per order. And then when we are coming to here, where our total cost of inventory, our order cost is basically the total amount for the demand that we have. So we need to be very careful here. So obviously this amount or this value is the same as what's over here, but it's not the same as what is the total order cost, if that makes sense. Okay. And then we also have our annual demand. It also goes there. There's our annual demand. And then we have our carrying cost, which again, we have similarities. Carrying cost. As per unit, we must remember that it's a per unit one. This is a per order one. And we have our quantities here. Okay. Right. Then just with our reorder point, I see I haven't included the formula there. Okay, we have our lead time times our average usage, and then we have the one with our safety stock. Okay, and then with safety stock, you must know how to calculate that. Either we take the maximum expected usage or we take the days safety stock held times our carrying cost. Okay, so you can see here that again, we have formulas that are cross-pollinating. So we've got here, going into here, and here, and then again our AU, etc., etc. Okay. I'm just wary of time. I do want to make sure I go through the two past paper questions. Okay, so with the optimal cash balance and the return point and the spread, there was a question earlier as to, you know, where are there more questions around this? I haven't particularly seen any, as in past paper questions. I will take a look again and see if I can find anything, but there isn't really. So you've got to rely on your textbook. And the last formula with the spread. All right. Okay, so I'm going to move now to the two past papers. I do want to make sure we spend enough time on that. The first one will cover the Learning Unit 3 formulas. The second one, it doesn't cover the formulas that we've covered here. Well, it covers some of the formulas. It's more of a change in credit term and what are the steps you need to follow and how you then bring in the investment in accounts receivable into that question. So that's a typical question. So before I move on to the past paper questions, can I just check if there's any questions on what's been covered so far? No questions. So I'm going to move on to the past paper questions. Like I said, I've got two, one for Learning Unit 3 and one for Learning Unit 4. Okay, so I'm just going to quickly bring that up. All right, so I'm going to share my full screen. So just let me know once you can see it. Just give me a thumbs up. Can everyone see the Excel and past paper question? Yeah, good. All right, so the first question we have is 15 marks made up of two parts, part A and part B. First part, it says calculate Conversion Limited's EPS after the share dividend. Okay, when they say share dividends, they are talking about scrip dividends. So you are issuing dividends instead of paying cash. Okay, what does that mean? It means that our ordinary share issued is going to change. So whatever shares we have in issue, it's going to go up because we're now issuing more shares instead of dividends. Then it says calculate Mr. Poland's market value of his holding immediately after the share dividend. So when they're talking about market value, they're talking about market capitalization. That's what they're talking about. Okay. This is part A. And then for part B, calculate the dividend per share that you would expect to receive from Grubber Limited. So dividend per share, we have the formula for that, so we can just use it. Obviously, just understanding what is the information provided. Okay, so let's do part A first. So Mr. Pollard owns 20,500 shares in Conversion Limited, a listed company. Conversion Limited had 410,000 shares outstanding, right? So when we say outstanding, we mean they are in issue. Okay, the recent financial statements indicated an earning per share equivalent to 12.5% of the current share price. Okay, so they're just saying that your EPS is basically 12.5% of your current share price. And Conversion Limited intends on paying 4.25% of the issued shares as a share dividend. Okay, so 4.25% of our shares outstanding, the 410, will be issued as shares. Okay, or as dividends, I mean. They'll be issued as shares, but they will be dividends, right? So Conversion Limited's current share price on the JSE, Johannesburg Stock Exchange, is 80 Rand. Okay. So first things first, we need to understand what are we calculating. So for question 1.1, we are calculating the EPS. Okay, so EPS is equal to, what is our formula? E divided by NSI. Okay, so if I go to my mural, this is the one I'm going to be using. EPS equals E NSI. I always start there. If I don't have that information, then I'm obviously going to change things. Okay. Right, so E divided by NSI. Okay, now, with our earnings, right, they didn't give it to us per se. So they didn't say to us net profit after tax is X, okay? But what they have given us is they've said that our earnings per share, okay, is 12.5% of the current share price. So if they're saying earnings per share, they're basically saying that if we take our shares multiplied by the earnings per share amount, we'll get our earnings, we'll get our E, okay? So to start off our calculation, we are going to say it is our 410,000 shares times the 80 Rand times the 12.5%. Okay, that is our earnings, right? Because if 12.5% of 80 is our earnings per share, it means if I times that, I get my earnings. Just think about if you had to do this formula, you would say your earnings divided by a number of shares, and that will give you your earnings amount, okay? Now, we're going to take our, or work out our number of shares in issue. Okay, so for our number of shares in issue, because we need to divide it by that now. Okay, our number of shares now. So this is where they're testing to see if you understand. Because of the scrip dividend, the dividend that we're issuing, we have to make sure that this number of shares for the company, so the 410, is being increased by the extra shares that we are issuing. Okay. So, I mean, there's two ways. You can say your 410 times 4.25% and add that to 410, or we can just say the 410 times 1.425, okay? Where we are just trying to increase, so 0.425, where we're trying to increase the share amount. Okay, so what would that give us? Okay, and then obviously we just solve for it. Okay, so you'll get 10 Rand, or if you had to show decimals.
Okay.
9.5. Everything okay?
Yeah, because the old EPS is 10. So it
Yes,
wouldn't
so
make sense if we'd have to show the decimals.
yes, yes. So generally speaking, when you're dealing with these kind of questions, you should try and keep the decimals because there's always a very small difference, right? And obviously rounding it looks the same. Okay. So for 1.1, that is our answer. Okay. Then 1.2. Okay, now 1.2 is asking us to calculate the market value of the holding immediately after the share dividend. So we know what our market value formula is because I showed it to you in case you didn't know. Here it's the market capitalization formula, the NSI times SP. So we're going to write down what we know, and what we know is that formula. Whenever you're tackling these questions, that's what we do. Okay, so it's the market capitalization is equal to the number of shares issued divided by your times your share price. Okay, straight from the formula that I went through with you. All right. However, we don't have the share price after the share dividend. This is important. We have the share price, the 80 Rand. We don't have the share price after the share dividend was given, because when you issue shares into the market as a dividend, it is going to impact your share price. Okay, so because of that, we have to first calculate our share price basically after we've issued these shares, okay, for the share dividend. Also, what's critical here is they've asked us to calculate Mr. Pollard's market value. Okay, Mr. Pollard is the individual. Okay, we have conversion limited shares and we have Mr. Pollard's shares. Please don't get confused here. That's what's also confusing this question. They're asking for an individual shareholder's market capitalization. All right. Now, in order to get the share price after we've issued the dividend, we have to use conversion limiters information. And we're going to use this same formula, but we're going to manipulate it so we get the selling price or share price. So it's going to be our share price okay, is our market capitalization divided by NSI. So literally all I've done is I have manipulated this formula. I've taken the S on the other side and then saying that I've got to, or kept the S on the one side, I'm saying I've got to divide MC by NSI. Okay. Now, I need to go and check what my market capitalization is, or I have to work out what my market capitalization is for conversion limited, because I need the share price of the company to work out Pollock's market capitalization. Okay, so the market capitalization of the company would be the 410 times the 80 Rand. Okay. And then we are going to divide it by the number of shares issued. Now, the number of shares issued is this number here. Okay, it is what we calculated as once the scrip dividend was issued. Okay, it has to be that because the shares have changed, right? Okay, so we will get and again, I'm going to just make sure we show decimals, 76.74. Okay, so the share price, once we've issued the scrip dividends, will be 76.74. So it's gone down, which makes sense because you have more shares in the market, right? It means that, you know, shareholders don't necessarily get more for the shares that they have, right? Okay, but we're not done. This is 76.74 is only for Conversion Limited. It's not for Pollock. And that's what they asked us. They asked for Mr. Pollock's, Mr. Pollard's individual market value. So again, we have to go back to here. What is the market value? Okay. What is the number of shares? Okay, so what is the number of shares for Pollard? Okay, so Pollard's number of shares is the 2,500. But we have to increase those shares by the 4.25% because he, as a shareholder, would have received a scrip dividend or share dividend. Okay, so we have to times it by the 1.0425. Okay, and then we're going to times it by the share price that we calculated. Okay, please remember this is what is tricky about this question. Okay. Okay, so it's the 21,371.25 shares times the 76, which then gives us an answer of 1.64 million. Okay, if you have a slightly different number, because obviously I'm using Excel, if you've used 76.74 like as it is, you would have gotten 1.640030, something like that. But if you got 1.64, you are still okay. Right. And that is part A done. Any questions? I'll check if there's no chat questions. Good. Okay, last one. For this Learning Unit 3 question, calculate the dividend per share that you would expect to receive from Grubber Limited. So Grubber Limited, a competitor to Grubber Conversion, has the below information which has been extracted from the financial records for the current financial year end 20th of February 2024. Ordinary share capital is 5.6 million. The shares are currently trading at 35 Rand, which is a 25% premium to the nominal value. Retained earnings is 640,000. Retained earnings on the 1st of March 2023 was 190,000. Management decided to only distribute all additional retained earnings earned during the current year as a dividend. So we must understand from the information that the retained earnings value here is a balance as of the 20th of February 2024, and they only want the current year. Therefore, we must take out the 190. Okay, first things first, we always start with our formula. So our dividends per share, as we had done here, it's this one. Our total annual dividend divided by NSI. It's a total annual dividend divided by our NSI. Okay. Okay, a total annual dividend, or what we have for distribution, in other words, would be the retained earnings for the current year, because they told us that. They say that is what they're going to distribute. Okay, so it is going to be the 640 minus the 190 all over, okay, our number of shares. So they've given us the value of the shares here. They've told us what the current trading value is and that there's a premium so for a nominal value. So whenever we're dealing with number of shares issued, it's always based on the nominal value always. Okay, so there's also other terminology or aspects they're trying to test here. So, okay, so you're going to take the 5,600, you're going to divide it by our 35 Rand, okay, times the 100 divided by 125, because we want to say it's 25% less, because premium means it is more. Okay, so we get our answer. Okay, so we get 2.25 Rand per share. And that's our answer. Any questions on this question? Okay, so remember, like I said, learning in 3, the formulas aren't bad, but they can ask it in so many different ways. So this is a completely different way to when you do share buybacks. Share buybacks completely different to this. So there's different things. We just got to tackle it by what is the formula I need to use? What do I have? What don't I have? Can I get the don't I have from other formulas? If I can, great. If I can't, then I need to keep on working out. Okay. Okay, so let's do number 2 now, or question 2. Can you choose learning unit 4? Okay, so I'm gonna share my screen so that you can see it. So just let me know if you can see it. Can you see question 2, learning unit 4? Everyone just put a thumbs up. Great. So this question is a typical change in credit terms question for your accounts receivable. Okay, remember, learning in 3, you can change the credit terms of account receivable. You can also change credit terms of suppliers, although that's mainly in learning unit 5. Okay, so this is quite typical for learning unit 4. So the required says, advise Pluto Company whether it should tighten their credit standards together with increasing the early settlement discount percentage. So this question is slightly different in that, or to the ones in your textbook, in that it takes into account an early settlement discount. Okay, generally questions in your textbook, when they do changes in credit terms, you will need to do 3 things. It's normally what's the impact on your contribution, what's your impact on your credit loss, what's your impact on your marginal cost of investment accounts receivable. Now, because we have settlement discount, there's a 4th element now. There's a 4th thing we have to calculate. Okay. And with these type of questions, I like to always say, what is the impact on the current policy versus the new policy? Compare the two and get the difference and say, what is the impact on my profits? Okay. So let's read through the details and see what it entails. Right. So Pluto Company is seeking to boost its profitability. I'll fix the spelling there. Considering the rising interest rates and heightened risk in the global economy, credit losses have become a major concern. Pluto is considering tightening its credit standards together with increasing the early settlement discount to encourage customers who can settle their accounts earlier to do so, with the hope that their good customers may purchase additional units in future to take advantage of early settlement discounts. Currently, the company's accounts receivable collection period is 80 days on annual sales of 950,000 units. The selling price is 55 Rand per unit, whilst variable costs per unit amount to 1/5 of that. Fixed costs per unit have been calculated at 3 Rand less than the variable costs. Credit losses as a percentage of sales are 6.5%. The company is proposing to increase the discount by 3.75% for early settlement within 15 days of the credit sales. The current discount offered is 1.50%. The directors estimate that the percentage of sales that would take the discount will increase by 1/3 from the current 30%. Further analysis has also estimated that the number of units sold will increase by 15%, the current accounts receivable collection period will improve by 25%, and the credit losses percentage will decrease by 1/2. The company's current cost of investment in accounts receivable is 16.80% per annum and assume a 360-day year. Right. So in essence, this information is current in essence. This has a bit of current, but also what the proposed policy will be. This information here is for our marginal cost of investment and accounts receivable, because we always use what the cost of investment is. And then we have our 360 days, which is also part of the investment and accounts receivable. So this is going to take into account these formulas here, where we look at your average investment in accounts receivable. So it's going to be incorporating this formula in there. Okay. All right, so where to begin? Okay, so let's start with the impact on contribution. Okay, why is there an impact on contribution? Because they said here that the number of units sold will increase by 15%. Okay, if our units sold increases, it means our contribution will change. Why are we doing contribution and not profit? Because profit takes into account fixed costs. Our fixed costs will not change whether we change the credit terms or not. So remember the definition of fixed costs. Fixed costs are costs that do not change with sales volume and with units of production. So whether we are increasing the sales units or not, or whether we're changing the credit terms or not, what does that have to, how does that affect fixed costs? It doesn't. Fixed cost is forever that, regardless if we make this decision or not. So in essence, it's sunk in this question. That is why we don't work out profit. We work out contribution. Okay, very important. Right, so impact on contribution. Okay, so the first thing we're going to calculate is the impact on our current policy. So we start with what we have. So contribution under current policy. And if you want, you can do a little table. I know in my solution, I've done a little table. It's up to you, you don't have to. Okay, so we're then going to afterwards compare that to the contribution under the proposed policy. Okay. All right, so what is the current policy, right? The current policy is we have 950,000 units times. We have our selling price, okay, which is the 55 Rand. Minus our variable costs. Remember, because it's contribution. Contribution is selling price per unit minus variable cost per unit. This is a revision of 2A, 2B, etc. Okay. Variable cost amount to a fifth of the 55. So it's the 55 Rand times 1/5. Okay. Or in other words, 20%. Right. And that will be all for our contributions, as straightforward as that. Okay, so what is the amount that we get? Okay, so we get 418 or 418, but 41 million in essence. Okay, so you can see there what the value is. Right. Then contribution under the proposed policy. So what's happening now with the change in credit terms? First of all, we know that our number of units sold will increase by 15%. Okay, that's what we know. The rest will stay the same. Okay, because the collection period doesn't forget our contribution, credit losses doesn't affect our contribution, and nothing's happening to our other pieces. So we're going to take the exact same formula that we had before. The only difference now is we are increasing our number of units by 1.15. Okay, so it's the 950,000, increasing it by 15%. Okay, so what do we get as the answer? Okay, 48 million. Right, now we've got to determine what is the impact on our profits. Okay, so impact, or what is the impact on our profits? The impact will either be an increase or a decrease. Okay, so what is happening here? Our contribution was 41.8, it is now 48.07. So we know it will increase in profits. Okay. Okay. So that is our first one done. All right, let's move on to the next part, right? Okay, so the next part now, so we've had impact on contribution, 1. The next one is the impact on credit losses. Okay. I'm just going to paste over this format. Okay, so impact on credit losses. Okay, so let's see now what's happening with our calculations. All right, so under the current policy, right? It says here that the current, the credit loss as a percentage of sales is 650%. That's what they've said. They haven't said, oh, they've said that the credit losses will decrease by half. So that's when you do the new policy. So under the current policy, it's 6.5%. So we're going to take our units, we're going to multiply it by the 55, because remember, credit losses is bad debts. Bad debts is based on your full debtors amount. Your full debtors amount is the number of units times your sales. Okay, so we're going to say it's 950 times the 55, and then we're going to say times 6.5%, not 6 rand 50. Because that's what they've told us, right? Also, just to note here, we've made an assumption, because we're not told otherwise, that all units sold are on credit. Okay, so please be careful, read the question. If the question says to you that only 50% of sales are on credit, you would then obviously have to reduce this by 50%. So just be careful. But here, they didn't tell us that, you know, there's cash sales here. We've assumed it's all credit because they haven't told us otherwise. Okay. Right, so then to calculate, and we get 3396250. Then under the proposed policy, okay, we take the 950. We need to increase the 950 by the units, because remember, it's increasing. We then have to multiply by the 55, but then we also have to then times it by the percentage that's going to be halved. Okay, so remember, it's the 950 increased by the 1.15. We then have the 55 Rand. We then have the 6.5 that's at half of the rate. All right. So what do we get as our answer? $1,952,844, and here, okay, is we will have actually a profit here. Okay, we'll increase in profits, because if our credit losses are going to be 3.396, and remember when we record credit losses, we record them in the income statement. So these are things we're writing off. Okay, the write-off under the proposed policy is less than we are making a increase in profits, okay, not a decrease. Okay. Right, then the next thing. Okay, so before we go on to the marginal cost of investment and accounts receivable, there's one extra thing in this question. Like I said, normally these questions only have 3 steps: impact on contribution, impact on credit loss, impact on your marginal cost of investment and accounts receivable. Here, there's a 4th one, which is the settlement discount. Okay, so that's an extra thing that we have to calculate. Okay, so early settlement discount under proposed policy. Right. So what are the details of the early settlement discount? Okay, so first of all, it's in this paragraph. Here they're saying that the current discount offered is 1.5%, and the directors estimate that the percentage that would take this discount will increase by 1/3 from 30%. So they're saying that at the moment it's 1.5%, and only 30% of sales take an early discount, right? So what does that mean? We've got to calculate that now. Okay, so we're going to take the 950,000 units times the 55% times the 30%, because only 30% will take advantage of the discount. And then we've got to times it by 1.050%. Okay, because that's what they said to us the value would be. Okay, so if we calculate it, okay, we get 235,125. Okay, then we've got to do it under the proposed policy. So under the proposed policy, again, we're taking into account the increase in units. We times it by 55 Rand because that's the selling price. We're then going to times it by 0.3, okay, because they told us only 30% of the debtors will take advantage, okay. Oh, but they said that obviously 0.3 will increase by 1/3. So just please be careful here. It's saying that it increased by 1/3. And they also said to us that the discount by, they will be increasing it by 3.75. So it will be the 1.50 plus the 3.75. Okay, I'll just drop this so you can see. Okay, so again, units being increased because of the new policy times 55 selling price times 0.3 being increased by 1/3, which is 33.333, times the percentage, which is being increased by 3.75. Okay, so how do we calculate that, or what's the answer that we should get? Yes, we should get 1261837. Right. So what do we have? Do we have an increase in profits or decrease in profits? Okay. So with an early settlement discount, it was 235. It's going to increase to 1.261, and it's going to impact our income statement because settlement discounts go through the income statement. So it's going to be a decrease in profits. All right. Okay, last part of the question. Okay, now we're going to look at the marginal cost of investment in accounts receivable. Take into account the formulas that we would have gone through, which is these ones that I showed you. This one here for average investments in accounts receivable. I just want to check something. Okay, so I see there is some answers in the chat that I'm just going to respond to quickly because I see Okay, so in terms of your question, all right. So for 1.2, if we just went 80 Rand times 500 gives you 1.64. No, not correct, because we are working out the dividend for the company. If you use 20.5, that is the number of shares issued for the individual. So not correct. Okay. It just so happens that the numbers work out. Okay, then again, with the repetition of why we don't minus fixed costs, we don't minus fixed costs because they are a sunk cost. What I mean by that is that no matter if I decide to change the credit terms or not, I'm going to incur those fixed costs. They're not going to go away, and they're not going to be affected by any unit change. Okay, and then I have, ma'am, on the impact on the contribution, why do we subtract 55? That is, so we're not subtracting 55. I'm getting the contribution margin. Contribution margin is selling price less your variable cost. In this question, your variable cost is 1/5 of the selling price. So what I'm doing is I'm saying 55 minus the variable cost, which is 1/5 of 55, if that makes sense. Okay. And the only reason why I'm doing that is because the question said that, right? There's a million ways to calculate. Okay, and I'll re-explain the figures in the second settlement discount. I'll do that again. All right, so let me just reshare because I did stop sharing. All right, so here, just on the impact of the early settlement, okay, what am I doing? I'm saying it is the 950,000 units that are increased by 15% because they said to us, if we change the credit terms, that our units will increase by 15%. I'm then multiplying by 55 Rand because that is the selling price and I need my debtors amount. What is my debtors amount? My units times my selling price. In this question, they haven't told us how much is credit sales. We're assuming all of it's credit sales. Okay. I'm then multiplying it by 30% increased by 1/3. Why? Because here the question said that the directors estimate the percentage of sales that would take the discount will increase by 1/3 from current 30%. So what they're saying is, under the current policy, only 30% of debtors will take the early settlement discount. Under the proposed policy change, which is a higher discount, they expect that 1/3 more will. So I'm literally increasing the 30% by 1/3. Okay. Then here I'm adding 1.5 to 3.75. Why? Because here they said that the company is proposing to increase the discount by 3.75% for early settlement within 15 days of the credit sale. So they're saying they are anticipating to increase this 1.50 by 3.75. So I'm adding it. I'm adding that increase. It's not increasing it by so it's not that they're taking a number and increasing that. Like inherently you want to go 1.50 times 3.75%, but because this is a percent and this is a percent, I'm adding the two together because I'm increasing the percentage by that, if that makes sense. So please don't get tricked by that as well. Okay, hope that answers this. Okay, assuming it will. If not, I'll go back again. Okay, all right, so let's just finish up this question because time is nearly up for us. So right, impact on marginal cost of investment. Okay, so when we're dealing with this, we're dealing with our formula on investment in accounts receivable. Okay, so we have investments in account receivable under the current policy. accounts receivable under the proposed policy. Okay, we don't know if we have a decrease or increase yet. Okay, when we're dealing with investment accounts receivable, we have to use the formula. Okay, what is the formula? The formula is this one. Average receivable days or accounts receivable days times our credit sales divided by 365. Okay, so we're using that formula. Okay, so what are our accounts receivable days? In the question, they told us it is 80. They said it here, 80. Okay, so I'm going to say 80 days times. Now I need to multiply by my, basically my cost for, or my, I know in the formula it says credit sales, but because we're doing the marginal cost, we're going to use the variable cost. Okay, so please, that's a difference with one of these questions. It's asking for the impact on the marginal cost, which is the cost of our accounts receivable, which in essence is the variable cost. Okay, so you're going to take the 950 times, again, it's at 55. It's just your variable cost in essence, minus what we did before, 1/5. Okay, so we did that 1/5. And then we are going to divide it by 365 because that's what the formula asks. Again, formula asks average receivable days, the 80, times the credit sales. In this instance, it's the marginal cost, the variable cost portion, divide by the 365. Okay, so that's what we're doing here. Okay, so if we calculate that, it'll be 80 times the 950 times okay, so I shouldn't get that because that's one. I must only include my variable cost. Please don't do the error that I did. It's only my variable cost because it's the marginal cost. Yeah, 2290. And also 360, please, because the question asked for 360. Okay, much better. Right, let's do the other one now. So our receivable days under the proposed policy will improve by 25%. So I've got to take basically this formula. I'm going to increase my 80 by the 25%. So I'm going to increase it by 25%. I'm going to times my 950,000 that's being increased by the 1.5 because remember we had the 1.15 that's been bringing through the whole time times my cost, which is the 55 Rand at 1/5, all divided by 360. Okay, so how do I solve that? And then we should get 3292468. Sorry. So just make sure here. Okay, so it said here that the accounts receivable collection period will improve. Okay, so it means that I actually have to reduce my days, not increase them. Please don't make that error. Okay, so I'm basically going to say my 80 less 25% of that. Okay, so in other words, 80 times 0.75 in essence. Okay, much better. 1975,479. Okay, so what does that mean? Our cost and of accounts receivable when on the current policy is more than the cost under the new policy. So it will result in what? It will result in a increase in profit because the new policy is going to decrease our costs. Okay, but we are not done. We have to now summarize these results. We have to say what the net impact is, and we have to give advice. The question says, advise Pluto. Okay, so how do we do that? We have to do the net impact. Okay, so the net impact will be, first of all, our contribution. Okay, it will be the credit loss. It will be the early settlement discount, and it will be your marginal cost. So we basically bring through the amounts from above. So our impact on contribution, we said it was an increase, so a positive value. We know the impact on the credit loss was an increase, so a positive value. We know that the early settlement discount was a decrease, so a negative value. We know that the impact, okay, of your marginal cost is this, but remember what I said, that we have to use this percentage, the 16.80, to calculate. So I'm going to say it is the 314,932 times my 16.80%. Please don't make a mistake on that. Okay. You're also more than welcome to do this percentage under this section if you like. I prefer to do it separately. So it'll be that times my 16.80%. Okay, which only gives me 52,908, and that obviously is a positive number. So my net impact will be the sum of the numbers above. Okay, which is a positive number. So what is the answer? Therefore, proposed policy should be implemented as it will result in a positive impact on profit of 6,739,603. Okay. Any questions on this question? Just want to double check that I haven't missed anything. Okay, so there are a few questions. So it's saying, okay, thank you. Got that. Where does it mention marginal cost? Also, if, for example, they say if 70% was credit sales, which part would you multiply by 70%? Okay, so they don't say marginal cost. Okay, so nowhere in the question does it say marginal cost. You must know that when you're dealing with accounts receivable and you're changing the credit terms, one of the aspects is to calculate the impact on the marginal cost of investment of accounts receivable. Okay. So it's not mentioned.
Casey, where's he?
Okay. Yeah, and then in terms, Matt, of asking, or Matthew, of asking, which part would you say 70%? So it would be the top parts. What I mean by that, let me just show you. So which parts would you multiply by 70% is here, where we say 950 times 55 Rand. We would times that by the 70% to only include credit sales, because that's the only thing that would be impacted by a change in credit terms, right? So this would be times by 70%, this would be times by 70%, this one and this one as well, this one as well. Yeah, basically all of them would be, because in essence what you're saying is out of the total units selling, only 70% are on credit. So everything would be impacted by it. Okay. Right. So let me just answer that. Okay, how did you get that 1975? Yeah, so okay, so let me answer one thing at a time. So yes, blessing. This is the structure for this question every time. Okay, the only difference is if you have to add in, like this one has settlement discounts. There's questions without settlement discounts, okay? Okay, so I've answered that. Then I have Mark, the 1975. Okay, so let me just go back to my screen. The 1975 here, okay, it's the 80. So it's the 80 days. I have to reduce it by 25% because they said to me that the collection period will improve, right? I made the error of increasing it. That means it won't improve, okay? So I've got to reduce it by the 25. I then times the units, which is increased for the policy. I then times 55 by 1/5 because that's for variable cost, and then divide by 360. That's how I get the 1975. And obviously, because I've used Excel, it's taking into account all my decimals. So that's the value it's giving me. Wait. Thank you. It's because of the 365. Yeah, so it should actually be 360. So you're right. It should only be 2209. Okay. So please don't forget, guys, I keep on putting 365. It's 360 because the question demanded it. There we go. So please don't do what I'm doing in terms of the 365. Follow the question, 360. Okay. So I've answered you. Should be the 2. Okay. And then let's see how else. Okay, then let me, so in terms of why we're doing that, I just explained. So we have to determine the accounts receivable days that have improved by 25% and then incorporate the rest of the proposed policy details. Okay, so Blessings asking if all okay, so then if not all sales were on credit, yeah, you only take into account the sales on credit because that would be your debtors balance, right? Okay, any other questions? Any other questions on this? Because time is up, but I just want to make sure there's any other questions. Okay, doesn't look like there's any other questions. All right, so that's it for this masterclass. So again, learning unit 3 and 4, I will make sure you get the video and content gets shared with your lecturers to share onto you. Obviously, I didn't cover all types of questions. I just chose one from linear 3 and one from linear 4. Please make sure that you go through all types of questions to cover every single aspect. So what I mean by that, share buybacks, you must know. EOQ, economic order quantity. You need to know, how to calculate your cash conversion cycle, all of those things. So please make sure you've practiced those questions. And if there's no questions, that's it. Good luck.